What if the chart you stare at hides a secret map? You guess entries, get stopped out, price reverses instantly. Now imagine you clearly read where smart money accumulates. Then catch swings with surgical precision, truly building consistent profits effortlessly. Master volume profile. Trade like institutions, not emotional retail. Disclaimer: results not guaranteed, for educational purposes only. Your discipline matters. By minute 3, you'll see charts with new eyes forever. Stillness creates clarity. Clarity creates memory. The method changes you. Think of it as an X-ray of the market. You stop seeing skin and start seeing bone. Suddenly, support and resistance aren't trend lines you drew. They're zones with physical weight. Stick with me and I'll show you the 3 lines that reveal where the next big move begins. These lines aren't magic. They're mathematics hidden in plain sight. The point of control, the price level with the most traded volume. Value area high and value area low. The boundaries cradling 70% of yesterday's activity. But why do these levels matter more than any indicator you've ever used? Because price tells a story. Volume tells the truth. A breakout without volume support is a trap. A pullback to the POC is an invitation. Those 3 lines map the market's memory. When price returns to the POC, the biggest players re-engage. You felt this. A stock reverses sharply from one spot, but you couldn't explain why. That spot was the POC. Stillness creates clarity. Clarity creates memory. Memory creates discipline. The 70% rule. Value area holds 70% of all traded volume for the session. The other 30% is noise. You've been reacting to noise. Amateurs chase breakouts. Pros wait for price to revisit value. Within the value area, markets balance. Outside it, they seek balance. Swing traders who hold days to weeks align perfectly with these zones, because institutional footprints don't wash away in minutes. There's one component nobody talks about that separates amateurs from pros. I'll reveal it in part 4. Volume tells the truth. Price can lie. Pause for a second. Look at your last losing trade. I bet it ignored these zones entirely. You entered above VAH because FOMO screamed. You sold below VAL because panic gripped. Same mistake, different ticker. It's not your fault, it's the method. When you anchor decisions to volume profile, reaction replaces prediction. Stop chasing. Let price return to value. That's where discipline lives. That's where your edge sharpens. You take a painful loss, and 2 weeks later you make the exact same mistake. You're not undisciplined. You're just using a method that ignores the true players. Because every billion-dollar position leaves a fingerprint, and once you learn to read it, you stop guessing. It's not your fault, it's the method. Big money can't hide. High-volume nodes are like crowded rooms at a party. Price magnetically returns to them because that's where the value agreement lived. You can almost hear the market whisper, "This is fair." When you see price repeatedly bouncing from a fat HVN during a pullback, you're watching smart money defend their position. Stillness creates clarity. Clarity creates memory. Memory creates discipline. You stop chasing and start waiting, because the real edge is in recognizing the magnet before it pulls. Let me give you a real example. Picture a stock consolidating for weeks, building a fat, heavy profile at a key level. That base is a fortress of accepted value. Then, on a single catalyst, price rips higher through a thin LVN. You now know that the breakout, if it holds above that crowded room, is legitimate. The smart money's footprint is the floor they built. You simply stand on it and wait for the next empty zone to become your target. Footprints don't lie. Follow them. Profit. You can't just look at one day, though. You need to layer the context. A composite profile aggregates years of data, showing you the truly anchored, long-term value zones where institutions have swing positions. A session profile shows you the recent battlefield. When a day's LVN aligns with a historical composite HVN, you have a collision of timeframes and a sniper's entry. Most people fail here because they never ask the right question. But timing the entry is where most people fail. I'll fix that for you next. You've watched price rip through your stop like it was hunting you. You waited, you planned, and still, the market made you feel like prey. It's not your fault. You were just missing the one piece that turns chaos into a map. This is the component I promised, the point of control, the single price level where the most volume traded in any session, the fairest price where buyers and sellers agreed on value. You need to see why it acts as a magnet, pulling price back again and again. It's a battleground, the line in the sand that defines the session's intention. POC is gravity. Value area is the playing field. Learn both and you stop trading noise. But none of this works without the right setup context. I'll give you the exact strategy next. Screenshot this section. You'll come back to it. Theory is useless without a system. Here's your exact step-by-step blueprint. First, identify the higher timeframe trend. You're not guessing, you're aligning with the market's heavy footprint. Second, apply volume profile. You mark the HVNs, the LVNs, and the point of control. These aren't lines, they're magnets for price. You see where the auction was comfortable and where it was thin. Now you have a map. But a map is useless if you don't know where to walk. Stay with me. Step 4 is where most traders' light bulb finally turns on. The frustration ends when you realize you've been trying to force entries in the wrong places. This is the moment the method locks in. You wait for price to return to a value area edge in the direction of that higher timeframe trend. Not a random bounce, not a hope. The market always retests its value. When it drifts back to an LVN just above a high-volume support in an uptrend, you pay attention. That thin, low-volume zone is where institutions ran stops and where liquidity pools. Your job is to let the trap set before you step in. Impatience is the killer, discipline is the cure. Stillness creates clarity. Clarity creates memory. Memory creates discipline. You don't chase, you receive. When price reaches that edge, you're already calm. You've already planned. Now, confirmation. You look for price action signals at the node, rejection candles, volume spikes, wicks that tell you the auction failed to continue. A long lower wick bouncing off an LVN in an uptrend is the market screaming that demand is still there. Volume spikes confirm the effort. You don't enter on the wick alone. You wait for the close. One candle can save you from a trap, and there's one filter that doubles your win rate coming up. But first, you must accept that no signal is perfect. The edge is in the confluence, trend, node, and rejection aligning like a lock clicking open. This is the light bulb moment. No more guessing. The chart tells you exactly what to do. Your stop goes just beyond the low-volume node, not at it beyond. Give the market room to breathe, to fake you out. The LVN is the line in the sand. If price breaks through, the thesis is dead. For targets, you aim at the next HVN or a naked POC left above. That's the magnet. Let's walk a trade. Daily uptrend, volume profile shows an LVN at 102, HVN at 105. Price retraces to 102.10, prints a hammer with heavy volume. You enter at the close, stop at 101.80, target 105.20. The market grinds up, fills the HVN. You exit. No emotion, just execution. Plan the trade, trade the plan, profit follows. You're staring at the profile again and it just looks like noise. But it's not noise. The profile has a shape, and that shape whispers what's coming next if you know how to listen. You felt that moment of hesitation where the move seems invisible. It's not your fault. Most traders are never taught to see the structure behind the volume. But that balance is just the setup. The next shape signals explosive breakouts. You'll want this one. It's the P shape. You'll see it after a strong rally with a fat bulge at the top. That's not strength. That's short covering or stealth distribution by smart money absorbing the buying frenzy. It's a bullish exhaustion warning, a silent siren. When you see a P shape, you don't buy the breakout. You prepare for the rug pull because the fuel is spent. Now flip that. The B-shaped profile is its dark twin. It forms after a sharp drop, the bulge hanging low. This is not a bargain. It's long liquidation or aggressive distribution, a bearish signal screaming that sellers are still in control. You see a B-shape and you pause on the dip buy. The shape tells you the trend isn't done, it's just reloading. Your pain comes from buying what looks cheap, not what is. The profile shows you the difference. Profiles are like clouds before a storm. Each shape forecasts different weather. You don't need to be a meteorologist, just a pattern observer. Look at the thin, elongated profiles. They're not bell curves at all. They stretch vertically, one long column of volume. This is a trending market with rapid acceptance, where price slices through time. No balance, no pause. This shape tells you to swing with the trend, not against it. Stillness creates clarity. Clarity creates memory. Memory creates discipline. You can be right 70% of the time and still go broke. Let that sink in. It's not your win rate. It's how much you lose when you're wrong. You take a painful loss, then 2 weeks later, you make the exact same sizing mistake. Not because you're undisciplined, but because no one showed you how to tie your risk to the chart itself. Position size isn't a guess. It's a calculation based on the distance to your stop at that key LVN. The wider the invalidation point, the smaller your position must be. This single shift moves you from gambler to actuary. Stillness creates clarity. Clarity creates memory. Memory creates discipline. And discipline keeps your account alive when the market does what markets do, humble you. I'll show you the 1% rule that lets you survive 20 losing trades in a row. You risk 1, maybe 2% of your total account per trade, no more. For swing traders holding overnight, this is non-negotiable. A 2% loss stings. A 20% loss ends careers. You're not trying to get rich on one setup. You're building a compounding machine that thrives on asymmetry. Now, pair that with reward. Only take trades offering 2, 1 or better, using the high volume node as your magnet target. You risk 100 to make 200. The math does the heavy lifting. You can be wrong half the time and still grow your equity line quietly, steadily. That's the invisible edge. Risk management is your seatbelt, boring until the crash that saves your life. You don't notice it during the smooth rides, the easy trend days. You question why you bother. Then a black swan hits, a gap down over the weekend, and while others are getting ejected through the windshield, you walk away with a scratch. Protect capital, survive, compound. 3 words that should be taped to your monitor. But your biggest enemy isn't the market, it's your own mind. The voice that says this time is different or I'll just size up to recover. That voice has bankrupted more traders than any bear market. Next, we go into the final boss. The chart isn't your enemy, your brain is. Let's rewire it. You map out a pristine value area, then price spikes toward it. Fear spikes harder. You abandon the zone, chase the breakout and regret. Or price falls to your value low but doubt freezes you. You watch the bounce without a position. Again, that's not weakness, it's ancient wiring. Evolution drilled urgency into your skull, but trading punishes urgency. The volume profile gives you a map, yet your mind tears it up. And the cycle repeats. FOMO, fear, frustration. It's not your fault, it's the method you're missing. So here's the mental edge pros use to wait for the perfect node without flinching. I'll hand it to you now. No gimmicks, just a rewired approach that turns your own brain into an ally. Trust this, watch the mental shift unfold. The mental edge is mechanical commitment. You set alerts at value area high and low. Then you walk away, not physically but mentally. You predetermine, execute only when price trades exactly at this level, with a stop at the low volume node. No adjusting, no peaking. Patience turns from struggle to structure. Stillness creates clarity. Clarity creates memory. Memory creates discipline. When you stop chasing, you start aligning with the auction. Volume profile shows institutional footprints. Let price come to you. Emotion fades when action is a checklist. Is price at value area high? Yes. Is the LVN stop set? Yes. Then execute, no debate. Pros don't guess. They respond. You'll cease reacting and start executing. The market becomes a sequence, not a threat. This routine rewires your brain to trust the map. Consistency breeds confidence. Embrace the checklist and noise fades. Why do you exit winners early but hold losers forever? Loss aversion. Pain feels twice as strong as pleasure. You grab a small profit only to see a runner unfold. You refuse a small loss, watching it drain your account. Volume profile rewires this. Set your stop below a low volume node. LVNs are voids, price rips through them. If that node fails, the zone is invalid and you're out without hesitation. No emotional debate. On winners, let profile's value area target guide your exit. Your stop and target lock to visible institutional levels. Confidence blooms here. You know where the big money is positioned because the profile prints their footprints. When you respect the LVN stop, you aren't risking hope, you're managing a predefined risk. Loss aversion dissolves into mechanical discipline. The charts stop being a casino and become a business. Volume profile is your compass. Stop trusting your gut, trust the map. Your gut evolved for survival, not for auction markets. The compass shows true north. High volume nodes are value, low volume nodes are express lanes for stops and targets. When emotion clouds your screen, anchor to the map. Master yourself, then master the market. These aren't slogans, they're the correct sequence. Conquer inner noise before exploiting outer signal. Pause now and ask honestly. How many trades did emotion cost you this month? Count them, the cut winners, the doubled down losers. That number is the tax on undisciplined decisions. Volume profile provides the process. Your mind must run it cleanly. Align these and the same setups that once caused pain become reliable income. No more sabotage, just structure. This is the shift from amateur to professional trading. Internalize it. Live it now. Avoid these 5 mistakes and you're already ahead of 95% of traders. Mistake 1. Using the wrong timeframe profile for swing trades. You take a painful loss. 2 weeks later, you make the exact same mistake. It's not your fault, it's the method. The volume profile on a 5-minute chart tells you nothing about the weekly auction. You see a node you enter, but the big picture is completely different. You get chopped up. Stillness creates clarity. Clarity creates memory. Memory creates discipline. Most traders don't even realize they're doing it. They think they're analyzing, but they're just reacting. And that's how the silent account killer creeps in. Mistake 3 is the silent account killer. Don't miss it. Mistake 2. Ignoring higher timeframe context and trend. You look at the intraday structure, but you ignore that the weekly profile is clearly bearish. You think you're finding value, but you're actually fighting the trend. That's why your trades fail. Stillness, clarity, memory, discipline. Now mistake 3, forcing trades when no clear value area exists. This is the silent account killer. You see a price you want to trade, but the market hasn't given you a real opportunity. The volume profile is flat, no clear high volume node to anchor to. You enter anyway, and you pay the price. Here's a mistake even experienced traders make daily. Mistake 4. Setting stops inside high volume nodes. You place your stop where the big players are waiting to shake you out. The high volume node is a magnet for stop runs. You think you're protecting yourself, but you're offering liquidity. Your stop gets hit, price reverses, and you watch. Mistake 5. Over-leveraging because the setup looks perfect. You see a beautiful volume profile, you size up, you go all in. But when the node fails, the leverage takes you out in seconds. Confidence without risk management is just arrogance. Stillness, clarity, memory, discipline. There's one final mistake that turns winners into losers overnight. Bonus mistake, revenge trading after a node fails. You take a loss and you immediately jump back in to get it back. You double down, you chase. The anger and frustration take over. The market doesn't care. You break your rules and you give back all your profits. How to fix this? Build a simple checklist. Before every trade, ask, is this the right time frame? What's the trend? Where's the value area? Where's my stop? How much risk? Write it down, check it off, make it a ritual. Stillness creates clarity, clarity creates memory, memory creates discipline. Let me tie this all together so you can start tomorrow. You now hold what 95% of traders will never understand. Let's lock it in. You started guessing entries, chasing breakouts, feeling lost. Now you see the footprints institutions leave behind. The fog has lifted. You've moved from hoping to reading the market's real story. That shift changes everything. Volume profile gave you the foundation. Value areas, POC, high volume nodes. You learned to spot where the battle really happens. Then you mastered the POC strategy, waiting for price to return to that magnetic level, waiting for the bullish or bearish signal bar. You saw how shapes reveal trapped traders and how risk management turns probability into profits. You confronted the psychological demons that make you break rules, and you learned to sit in stillness before acting. Now the method is inside you, but knowledge without action is just a dream. So before you go, I'll give you the exact next steps to start this week. Don't skip this part. It's where transformation solidifies. Start small. 1 share, 1 micro contract. Scale only when your journal proves you can execute cleanly for weeks. Confidence grows from evidence, not ego. Remember, the market doesn't create your emotions. Your reaction to it does. Stillness creates clarity. Clarity creates memory. Memory creates discipline. You'll see charts differently forever now because you're no longer watching price. You're reading intent. The open loop closes. You have the lens that reveals institutional footprints. The rest is your commitment. Now I need you to act. Hit like if this series shifted your perspective. Subscribe and hit the bell because future videos will sharpen this edge further. Most importantly, comment the word trading below. That single word is your public commitment to applying this method, an accountability anchor to your future profitable self. Then, check the description for your 2 free gifts. The 15-step checklist to use before every trade, which will skyrocket your consistency, and the risk management calculator to never risk too much again. They protect your capital as you build mastery. The map is in your hands. The market is waiting. Walk the path. I'll see you in the next one.